All right, guys, here we go.
So,
Another episode of Bros Banter. And today, I want to talk about a very, very real possibility, which is the Great Recession coming.
the Great Recession, not the Great Reset.
No. But to be honest, The Great Reset by Glenn Beck, great book. Look at Glenn Beck's stuff. It's honestly, it's pretty good. Some of it's a little bit out there, but once you start understanding these elements that are tied to reality, and especially in the economic cycle, you start seeing that some things, they do add up. But that's neither here or there. We're not talking about the Great Reset.
But before we delve in, I, for one, welcome our reptilian overlords.
Okay. So, guys, let's talk about recession, because something pretty crazy happened this week. So, bonds.
Okay, I thought we were talking about something happened in Ukraine, something happened in Russia.
No.
Something happened in
The economy.
in Yemen, something happened in Syria. No, straight up. We're talking about something happened in the bond market.
No, well, the economy. So what happens is that, and you know this. So the way the bonds work is that you have short maturity bonds, and then you have the longer maturity bonds. When I say maturities, I mean that bond will expire. You could buy a 1-year bond, 1-year maturity. So meaning you buy a 2000. Let's say today we're what? We're April. So let's go June. You could buy a June 2023 bond, and at the end of that maturity, it's going to be worth $100 no matter what, because that's the way a bond works. You're pretty much loaning out money. You're getting back an interest rate bi-yearly, so twice a year, and that's your bond. Now, the closer you are to maturity, the less that bond yields. So by meaning that you're getting nothing over the credit payment that they owe you. It's not very interesting.
Mm-hmm.
And if you because you're also taking a risk, but because it's so short term and it has to mature at $100, so the interest is fairly low. You're not going to make tons of money with it. Now, if you were to buy a 30-year bond, well, obviously, you still have that interest coupon that they pay you bi-yearly, but also that the price in there is going to have a yield. So meaning that bond is going to trade, let's say, under $100, and it's going to yield more. Why? Because it's further out. There's a little bit more risk to it. And it's only natural, because if you're going to park money somewhere, well, that money has to earn you something.
And
So-
also, when you collect your $100 in 30 years, it's not the same $100 that you were initially invested, saying that $100 you're going to get is going to be following inflation, following
Exactly.
everything. So
Bonds are a safe investment, but obviously the returns aren't great because they're super safe. But what happened normally, there's a curve to it. So like I said, the shorter term bond will yield not much, and then the longer term bond will yield you a lot more money. But what happened this week, and what's been happening ever since COVID, is that the short-term bond has been yielding just as much as the long-term bond.
So you're telling me the
Bell curve is inversed.
and they cross the streams?
No. Okay.
No, they didn't cross the streams.
There are no streams. Like I said, if you follow the bond curve, it's supposed to go like pretty much like this.
Okay, but how's the stock market looking? Because
The stock market
other-
had been rebounding a little bit. It had been very bearish. It had went into a bear trend, so meaning it was correcting, but it sort of popped back up because the federal bank or even the Bank of Canada had been, even though everyone knows rate hikes are coming, the consensus was, well, it's already priced in. But when I say priced in, is the market currently was already reflecting all those hikes. That happens, by the way. The market, so the stock market is always 6 months in advance. The bond market is usually always a year in advance. And,
Yeah.
and the reason why that is because we always say this, the stock market is always forward looking. Like the price that you're going to see in a stock right now is already considering the results that company is going to give you 3 months down the road, sometimes even 6 months down the road. So that's why we always say markets are forward looking. Now, the bond market, since it's a yearly thing, it's always a year forward looking. So that's why what we're seeing in there is usually a little bit more of a longer term perspective. But because stocks are forward looking and everyone was talking interest rate hikes, that's why people were thinking, well, these hikes are already priced in the market because the S&P, the indexes, had all crashed. Not much, but they had corrected. Let's say corrected. So what happens in that case is because the federal chairman of the bank, I think in Canada, I don't remember who it is because it's super irrelevant, but in the States, the Fed chairman, Jerome Powell, has sort of changed his vocabulary, saying that we're going to hike, but it's even though we're going to hike the rates a lot actually, it's not so bad. So the market was super optimistic because they're like, oh my God, wait, it's not so bad. So we've already corrected maybe too much. Hence, the stock market started rising again. It went back into a bullish trend. The S&P trade over 4,500, which was sort of like the magic number that says if it's over that, it's bullish. If it's under that, it's bearish. So it had popped over. But this is what happened, like I said. And this is a super rare event that happens when the yield curve on the bonds, because remember, the bonds are always forward-looking by a year. Once the short-term year bonds have been yielding as much as the long-term, well, that makes no sense for investors, right? Because why would you buy something that's giving you as much yield in the short term that it would be giving you in the long term? So something's fucked. Well, yeah, something's fucked. And that happens only when we're on the cusp of a recession. In the last 100 years,
It's always hit the same marker.
that's it. When the short-term bonds yield as much, when the curve inverts, it's always pretty much, that's when a recession hits. And that happened this week, by the way.
Okay. But when we're talking about recession, first of all, most people automatically get scared.
Yeah.
Because they think, they automatically have this notion of the Great Recession, which actually pretty much nobody left alive actually lived the Great Recession. Maybe a few people.
Yeah.
Maybe not. Maybe not. Okay, but the latest recession, which was not even a real recession, was in 2009.
That's it.
But that wasn't a real recession because that was a recession created by some pretty fucking stupid ideas by banks called asset-backed loans, and the market imploded. Great movie, Big Short. If you want to understand
it's a great movie, by the way, guys.
it's
Watch
accurate. It's very accurate.
Not only is it accurate, it gives you a good outlook on how things can go. Because, by the way, the housing market, the mortgage market will feel the pain if there's a recession. Now, because this just happened, people are saying, well, that it doesn't mean that it's absolutely going to happen. If you look historically, every time that a recession has happened, it's when the yield curve inverts. So this just happened this week. And suddenly, the stock market that had been in bullish territory is falling back into bearish territory. So what that means, okay? It means that we sort of bounced back out of COVID a little bit too quickly. See, unemployment right now is already super low.
Oh yeah, right now in Canada, I think there's 31,000
We're at the
lacking employees.
We're almost at the lowest numbers, both Canada and the U.S. Historically. So what does that mean? Coming out of COVID means that people can get jobs.
Easy jobs,
But why is that? Because it's like a perfect storm currently. We had been pumping out money so cheap. Employers needed people to work. They've been paying them. So unemployment went down. Stocks, super overrated, super overvalued.
housing super overvalued.
Inflation running rampant, historic highs in inflation. And there you go. The yield curve inverts. Now, what happens from here? And again, not a financial advisor, but just by the facts, if you look back at unemployment, when the yield curve inverts, 6 months down the road, or we could even say 3 months, people are going to lose their jobs because that's the way it works. Now,
But wait, okay. And I'm not saying that you're wrong, but I'm saying, okay, right now we actually have a lack of people working. So in 6 months, other people will lose their job. And this is, I'm just thinking about this out loud. But what happens? Will it be all across the board, or will it be specific jobs in the sense of like the companies are probably going to try to, go into recovery and safety mode.
they already are.
So they're going to let go probably the most expensive.
Yeah, of course. Because what happens is that since inflation is so high, and we've been pumping out all this money, and now they're going to raise the rates, well, the cost of that money is now more expensive. And the whole point of why we're raising rates, by the way, is because we're hoping by raising rates, people will stop spending on things that they need to buy. But the other effect of that is by raising rates and making things apparently, well, that's the thing, things will still be expensive for a while. But that's the thing though, people, they're still gonna buy these things. The cost of borrowing money is gonna be so much more expensive because we're raising rates. And that's why people are gonna, it's the same for companies. They're gonna have to let go employees because now those salaries that they were paying, it's suddenly the money is the actual worth of the money is, how can I say it? That money's worth more. So by paying that employee, well, because you're borrowing a lot more expensive, do you actually need that employee?
Yeah, okay, I can see that. So what might actually happen also is you'll have because I can see a little spin coming out of it, going like, yeah, the job market is being hit, but people will be like, no, there's tons of new jobs created, and as we call them, McJobs. It's going to be like,
but remember, these company valuations are sky high. Like if you're Apple right now, and you've been record after record, and you've been paying the staff, but now you're in a recession, and nobody's buying stuff anymore because the cost of borrowing is now more expensive, and those same people that were buying things expensive now they're leveraged to the tits,
and mortgages
go up.
Mm-hmm.
People go broke, companies go broke. All these overvalued companies will correct. We've already started seeing it in the stock market. Your company can't lose 20% of its value without you letting go staff. You have to react to that. And companies are going to let go of their staff because you can't keep people hired. Remember, investors want results, right?
Yeah.
If you're an investor and you're investing in Apple or you're investing in Tesla, you want to see results. And God forbid, you don't want that company to cut its dividend. So if that company doesn't want to cut its dividend and you're not seeing results, how do you make results speak without producing? You let go people.
All right. So that you said something really interesting. Take for example, Tesla. Super awesome speculative company.
You know what? Probably the best speculative company you could find currently on the market.
Absolutely. But their product is geared towards the elite.
Yep.
It's very difficult to get, very prestigious.
Oh, by the way, did I mention that we're in a commodities crunch?
Yeah.
Where there's this war going on, if we call it a war. It's hard to get materials to build semiconductors, to even build parts for these cars.
Yeah.
God forbid, even the minerals that you need for these electrical vehicle batteries. Now, like you said, the car's already expensive for Tesla.
So what does that mean for a company like Tesla? Because honestly, their bread and butter is all about they're selling something. Like it's not the guy that's doing delivery or the young student that's buying a Tesla. It's like it's that person that's making at least 85 to 120K, and he's doing that as a sort of
They've got to make
investment.
less money. They have to. I know it makes no sense, but they have to make less money because if you can't build the car and you can't sell it because it's too expensive, what the fuck do? You have to lower the price.
But you can't fucking lower the price unless you're willing to take a hit for the time it takes.
And your stock's going to correct. But if you don't want to take that hit, you're going to fire people.
Yeah, because especially because I like the idea of using Tesla because Tesla, it's almost like it's not an actual auto manufacturer.
No.
They're manufacturing cars, but you got to pre-order them and then they build it and then they send it to you. So it's not like he's pumping out 100,000 cars every year and people are buying them. No, it's like.
And by the way,
he's got a book.
I dare you. Forget Tesla. I dare you to go to a car manufacturer or a car dealership right near your home, and God forbid, ask them how many cars do they have in their float? And we're just talking about regular gas cars.
Yeah,
I guarantee you their float is almost empty. God, and forget about electrical vehicles or hybrids because those are more expensive and they're even harder to make. We can't even get the chips to get those cars out of there. So like I said, it looks like the perfect storm.
Honestly, it is. I was it's not really off topic, but I was listening to the news this week. I still listen to the news every morning. I listen to
it's like comedy
CBC.
hour.
No, I like this. I like CBC because CBC radio because I find they're actually kind of very objective still. They just read the news. It's a news.
They can't show you fancy images to distract you.
Exactly. So, and there was a segment they were talking about how right now all the recession, the inflation, this and that, and they looked at the past. And it's a subject I touched with Paul on one of our podcasts. They were saying, okay, so right now, back in the 1980s, to get your cash down, the average person would take about 5 years to get their cash down for a house. Now they've calculated and estimated that a person would need 14 years to get their cash down.
Does that make any sense?
So just telling you, folks that have their 20-year-olds at their home, I hope you love your son and your daughter. She's there for 14 years.
Because he can't get into that market. Again, it's the perfect storm.
Yeah.
So you said it. Now let's talk about the housing market. So a true example, we bought a house, my girlfriend and I, last year. It's not even been a year we've been in there. We paid $510,000 for it. Same house, or at least almost the same house. One of our neighbors, 2 houses away, it's almost the same house. A little bit, less yard, but regardless, he put up his house in the market. He had 3 offers over $700,000.
I'm going to be honest with you.
That's more than
your house is a nice house.
It's not worth.
It's a good family starter. It's clean. It's well proportioned. It ain't no fucking palace,
dude. That's almost $750,000.
Yeah, who's going to live in there?
Well, see, that's the thing. Because things are so rare to get.
I'm tired of hearing people because I keep on hearing people. Oh, it's these elusive Asian investors.
No, it's not.
I know.
It's not. It's again, if you don't, and this is what COVID created, by the way. If there aren't enough things for you to buy, it creates a bidding war everywhere. And because of that bidding war, well, you're not seeing regular inflation on things. You're seeing hyperinflation. Listen, 3 offers over $700,000. Listen, I'm happy because at the end of the day, I look at a potential correction. I'm seeing, okay, well, if this guy just put the benchmark at over 700,000, at 500,000,
even if you drop $100,000, you're like,
I'm still good.
I'm still money good.
So I made to me, in my sense, that's a good investment that I made. But again,
doesn't make sense.
Makes no sense.
And here's the thing that people forget, because it was recently somebody that I knew sold their house like for $810,000 totally not worth that. It doesn't make any sense. And everybody's like, wow, that's a lot of money. Yeah, but what the fuck are you gonna buy after? You're going. It's like exchanging 4 quarters for a buck. It's like you're going like, unless you're ready to significantly downsize. But here's the catch: if you're downsizing to what they've downsized, like now they have a townhouse that's $560,000. It's not even worth that.
Worse, you're moving to Timbuktu because no, but it's true. You laugh, but you have to. If things are expensive, because we're around the Montreal Island right now, but that 1 million home here is not as impressive as it was. But if you go to Shawinigan, that 1 million home here, over there you'll pay $300,000 for it, and it's just as big.
And if you want a 1 million fucking home over there,
yeah, you have a castle.
You got a castle. You got 3 dogs and a couple of manservants.
That's it. You got 3 baths. No, I not even kidding though. Go to Shawinigan. You know what? Google it. M&S. Go check out the realtors over there. Look it up. Try to find any house over there. And I kid you not, the houses are so much bigger and so much cheaper. Why? Because it's out in the middle of nowhere. So you can't buy anything around here anymore. Like I said, it's the perfect storm.
The perfect storm, and you got and you're right. Like people, it's when you hit, and that's the thing that they teach you in macro and microeconomics when you do it in university. Because I had the pleasure and unfortunate, I did it. And by the way, you could all learn this on if you spend some time on Google. But so they say, you eventually have a recession when you enter max output. Max output, but they always explain it as a max output in like construction or material goods. But the problem is that playbook hasn't evolved. We've reached max output in housing. That's max output. We've reached max output in jobs because we don't have enough people for jobs. And all the other circumstances.
You said it too, by the way. You said something. 14 years to put a cash down. How much of a cash down? 10% or 20?
20%.
So 20%. Well, today, you can put 10% and borrow. Like, let's say you buy a $1 million home. So you're going to put $100,000 down, and you're borrowing $900,000 from the bank at, let's say,
and
2%.
Let's say you're a complete jackass and you believe that nothing will change, and you're going to go for the variable rate because your balls out.
Well, by the way, realtors, they get a better commission if they sell you a variable rate. So let's say you took a variable rate. Now we know, and the stock market is forward-looking, has already told you that 6 or 7 rate hikes are coming. So let's say they're conservative. They hike by 0.25. So what is that?
That's 3%. That's
3%. So you went from, let's say, 2.5
to
2.5, and now you're at
6.
You're at 5. Let's say the bank, because they also have this thing that they can give. It's called a bank discount.
And the banks are also going to try to play on this because, let's not forget, folks, banks are not in the business of owning houses.
No.
So they're going to try to save their asses.
Houses are depreciating assets. In all honesty, they should be. Remember, your house, if you buy something and you're not doing anything to that thing, you're not maintaining it, you're not taking care of it, it's the depreciating asset. So the bank has to throw that number or that evaluation or that mathematical equation into that valuation. So again, that's why they're not in the owning houses business. So like you said, it's completely nuts. But imagine, you have $900,000 worth of mortgage. You just went to 5%. But you didn't just do that on your house. You did that on your car. You bought a nice big truck. Or you bought a Tesla. God forbid you bought a Tesla.
Dude,
because you want to be green. You want to be the future.
Stop it, you're killing me, man.
No, but I'm telling you, so you're to be honest, you go broke.
You go,
You go broke.
you go broke. Hey, going broke is the least of your worries. Before going broke, you're indebting yourself probably on you're maxing out everything to keep it afloat.
Oh, by the way, if you're doing that on your credit card, then that's 20 to 22%.
Yeah, exactly. So you're maxing out everything to make ends meet. Because hell, you don't want to sell. Because a lot of people, let's be honest, for a lot of people, downgrading is a psychological thing. They feel like they're failing,
Oh.
and they'll crucify
My
themselves.
favorite song, Baby Come Back.
Yeah.
Because you're going to think that market's going to come back, but it's not going to come back. It's not like a rubber band. It's not going to bounce back like that.
And you're going to and a person will have the potential of doing all the wrong moves and doing all the wrong things to himself. Get deeper in debt to try to keep it afloat. Pick up a nasty little habit called drinking because you're stressed.
Oh, yeah.
And then, baby, we're going to need to, I'm too stressed, man. We have to go on a vacation. I got to get away, which we call escapism.
Yeah.
So, hey, tack on a couple of extra grand to your debt because you're going to Cuba for a week just to forget it and come back to the shit
There is
show.
no pretty outcome to this. But again, so now we know that we're going in this recession. It's to me, at least,
Before you get there, I just want to tell you one story quickly about how this makes complete sense. You know when everything's wrong is when you hear this. You got equity in your house?
Yeah.
How much equity?
Well, I mean, we put a huge cash down when we bought it.
So you got what? Maybe 50K.
Over 100.
Okay, you got over 100. Okay. So I got a deal for you. Lend me 60K, and I'm going to give you an 8% return on that within 6 months. All right? I'm going to take your 60K. I'm going to go see Matthias that wants to buy himself a house, doesn't have the cash down, but he's going to be like, no, bro, lend me that 60K. And I'll be like, okay, I'll lend it to you at 12% interest because I got to make myself the money.
Oh my God! Suddenly,
I got to make myself the money. So after that, but you're going to pay me back as soon as you get your bank loan approved.
Oh God!
And then Matthias is like, yeah, of course, I'm going to pay you back the 60 plus 12%. And I'm like, okay, cool. So after that, I give you back your 60 plus 8%. I made myself a 4%. I'm rich. You got your money back. This guy has to hold a fucking
the bag.
a bag.
So I'm borrowing money that you borrowed from him.
Yeah.
Yeah, that's the whole concept of.
Have you ever heard of loan sharks?
but this is all legit. I've seen a guy do this. It's a contract. It's like these open little shops of loaning equity.
By the way, we know one of these guys.
Yeah.
This is why I'm even more. I'm like, wow, it makes sense if you got into that business. You started that business 2 years ago. Great, good for you. You're ahead of the curve. It's these. It makes perfect sense. That's like, I mean,
If the economy is at that point,
if you're a son of a bitch and you want to take advantage of people, you're fucked. I mean, that is a great business.
but it's
wrong,
also
but it's a great
symptomatic.
business.
It's also symptomatic is that people are getting what we call in the business world bridge loans.
Yeah.
Pardon me. I thought I put that off. What we call in the business world a bridge loan.
Yep.
Which is okay if you're doing it for a business and you have a business plan and somebody's going to look, is going to give you a really good examination.
Yeah.
But people are doing this to buy houses.
No, it's a bad transaction.
That's
Listen, the whole point of this was not to discourage people, because what I always try to say when it comes to the stock market or all markets is the first thing is knowing. Like G.I. Joe, knowing is half the battle.
yes, it is.
So because you know these things, and because everything, by the way, if you're listening to us right now, everything in the world should be telling you that this is going to happen. There is no way for you to, there is no plausible way other than a miracle which I doubt will happen because we're looking at historic numbers here. So we're heading for the recession. All right, that R word, that scary R word, is going to happen. So, and this is, again, I'm not a financial advisor. I can't tell you guys what you should be doing, but I can tell you what I'm doing. And what I'm doing right now is, so I was panicking the last 2 weeks. I was looking at the stock market bounce back. And obviously, like, I mean, my whole outlook has been bearish in the market. But I looked at that snapback, and as we were heading back into bullish territory, I starting to panic. And I looked at the stock market, I'm like, geez, are we out of it yet? Does that mean we're out of it? Should I flip around and go long? Which is normally what you want to do. You want to follow the trend. But when I look at all these things, I look at the market, I look at just the whole housing market. Well, I decided, you know what? I'm betting. I'm currently betting against the housing market. So I bought call options on inverse ETFs against the housing market. So I'm going all in, betting against the housing market, and I'm also going all in, betting that people are going to default on their mortgages. And on top of that, all my long positions, I could be selling calls, but I decided, you know what? I'm just going to buy puts. Buying puts on options, like, I mean, it means that you're buying the right to sell something at a price that you decide. And trust me, I'm buying 4 months to 5 months out of the money puts. I'm paying expensive for them because I think I am pretty 100% sure that the stock market is going to correct another 14 to 20%. These valuations are too high. So am I making the right decision? Again, when you're trading stocks, when you're trading anything, it's speculating. You're speculating. But I can't see how the housing market's going to keep going up. I can't see how people are going to respect their mortgages with all these rate hikes coming. And again, if we're going into a recession and you can't, I mean, and your
you're
employer,
not mentioning the inflation, the gas price,
that's another indicator too. The gas price
through the roof. The food, the cost of food is like went through the roof.
Last time prices were so high, I think it's the early 2000s. The market tanked because it is unsustainable.
Because people can't afford. And that's what that's what something sometimes irks me about people that don't take the time to actually inform themselves for themselves. They just listen to one talking asshat that puts on a suit that's on BNN or CNBC or even, heaven forbid, the news, and he's our business correspondent or the guy that represents the bank, and going like, well, this, and I'm going like, yeah, guys, but people have disposable income. That disposable income can stretch this thin. It's like an elastic. Eventually, if you keep on trying to stretch it
with cheap money,
and that's also the thing that I find that nobody talks about. It's like, guys, we are coming out of a historic decade of the cheapest cash there was in the past ever. Like, because before that, it wasn't like we weren't. It was not the same reality. It's like when Dad was in his 20s, late 20s, early 30s, wasn't the same reality as today, where there's global economy, there's all these new factors that nobody's counting for. So lots of competition, lots of demand, lots of offer, but right now it's hitting a point where nobody can afford to pay. Like Sezzle. Best example you could ever find. When people can buy shit on payments, regular shit, like t-shirts.
That's it.
Like
t-shirts. You can finance a fucking t-shirt.
It's Redcon.
It's awesome if you can pay it.
Yeah.
But if you're financing it because you're broke,
Yeah, and you just want swag.
that's an issue. That is a real issue. God, I don't want to even look at your finances elsewhere because you could be financing everything.
And I think that's what a lot of people are doing.
Dude, it is so dangerous. And that's why I'm betting against the market. I'm betting against everything. I think it's going to correct. And listen, it might not correct next month, the month after that. But I think down the road, 4 or 5 months from now, the market we're looking at is a totally different landscape. Stocks are going to be tumbling down. Houses are going to be, now we're going to see the housing market burst. That bubble has to burst. And I don't care. And that's the thing. I think also in the housing market, what we saw was a squeeze.
Mhm.
Just like in stocks, by the way, because I want to explain this concept, what a short squeeze is. So a short squeeze is when, so you can sell things before you buy them. When you sell something you don't own, that your initial transaction is you sell it. Well, you're selling something you don't own, so you have to borrow it somewhere. But you're not borrowing it in reality. You're just borrowing the right to sell it. It's a tough concept to get at first, but just imagine that you sold something that you don't own and you got to pay something to have that right. So you're being charged an interest rate. Now, what happens is a short squeeze is the person who gave you that right, he might say, listen, I don't want to give you that right anymore.
Mhm.
So forget the interest you're paying me. Like, you're done. You got to go buy it back. Either because you can't pay me the interest anymore and you're broke, or I don't want you to have that right anymore. So what happens is you have to go in the market and you have to buy. You have to cover. You have to buy what you sold that you didn't own because you have to net out zero. But what happens is if there's a lot of people that have shorted something and it goes up, well, just keeps on going even quicker.
Mhm.
Something that was worth $1 could be worth $100.
That's what happened with AMC.
And that's a short squeeze.
Yeah.
So I think that's what we're seeing in the housing market right now.
Yeah.
Not enough supply. And because everyone wants it so bad, because they sold their home, by the way, before buying the next one, because they didn't have the cash in the account. It's the same thing as a short sale. Well, now they've got to leverage themselves to the tits.
To get something that's close to, and if they can get it. So, you know what? Best piece of advice? Lower your spending.
Oh, yeah. Budget.
Budget, lower your spending, and what you apply when you go grocery shopping, apply it to your investment.
Start couponing, man. Start couponing.
Go get yourself that app. Pro Hero?
Food Hero.
Food Hero. Where you can get yourself that app and
Food Hero or Reebee.
Yeah.
They let you know which flyers, which groceries are cheaper than others.
and apply those same tactics to what you're investing in. As soon as you see something, do your homework. Do your homework.
I don't know if you guys have noticed this, by the way, too. When you go to the grocery store and you see that nice piece of steak, look at it. Look at the quality of it. Because I guarantee you, that piece of steak that was maybe $19.99 a pound,
Mhm.
if it's the same, if you see the same price at the grocery store for that same piece of meat, check out the quality. It's not Angus. It's not Angus beef anymore. It's not AAA. It's not even AA. It could be single A. Like, these are all things that consumers, we don't notice because we assume it is the same type of meat. But it is not the same type of meat. There are different grades of quality. And as a consumer, they don't have to put that on the labels. So if you don't bother to look or read the fine print, you're buying lower quality meat for the same price you were buying that Angus beef 2 years ago. So for you, it's not a difference, but quality-wise, for what you're paying, you've just been bamboozled.
Yeah.
And that's how they get you currently with the inflation. So that's why, again, I am super betting against this market. And I'm not telling you guys to do it, but I'm saying if things don't make sense to you, start looking at financial instruments that'll help you make money off of this. Because, yeah, you know what? Maybe I'm not patriotic. I am rooting against the economy, but at this point, you can't change historic facts.
And I'm sorry, but at this point, you have to be against the economy because it doesn't make sense. Because we're going into what they call cannibalistic capitalism, where you're cannibalizing the economy is cannibalizing itself because it's out of control, because it's the capitalist swing into it is too big. It's just going to eat everything in its way.
Again, man, just imagine these companies.
Okay, but what do we invest in? Like, okay, I'm sticking away. If I was going to invest into something, I'm staying away from gold because.
Well, that's the thing. Gold is still a commodity. Gold is still the. So that's the thing too, right? So just.
But if I was going to invest, gold, I find it's too expensive to begin with. But it's definitely going to go up because as soon as people panic,
they buy gold.
So if you're a gold bug at heart, the panic is right around the corner. You know what I mean. You know what's going to happen. Do what you got to do, and also stock up on guns and bottles of water.
So to answer your question, buy materials. So buy companies that are, or buy material companies. So they could be commodities, it could be minerals. Those are good bets because the world is still, regardless, we're not. Our phones are getting better every single year. You need more microchips in those phones. You need more microchips, more semiconductors in those cars. So buy chip companies, buy commodity like minerals that are used to make those chips or make those devices like your cell phone, your TVs. Invest there. Maybe look at ETFs that are based on consumer goods that you need, fundamental consumer goods. So groceries, things that you know that no matter what, as a consumer, you will go buy. Because remember, Apple, if nobody can buy the phones, they ain't selling the phones, but they still got to build the phones. So that's a risky market. That Apple will correct. But grocery stores, they're still going to sell grocery food. So again, you got to look at stuff like that. So minerals, essentials. And again, if you want to be like me and wild, just bet against the market. Just buy puts on the S&P.
I'm going to be a real jerk. I'm going to say to people, you know what? When people panic, people feel like trapped. People go and pick up the worst vices. So check out beer companies, alcohol companies, again, RJ rental, cigarette companies. Look, if you want to, and I'm going to, I'm marijuana companies, anything purveyor of vice that give escapism. I'm guessing those stocks are going to have eventually a pop because when people don't like to feel panicked. Yeah. So as soon as they feel panic, and I'm the same way. We get a bad news, I'm gonna go have a little drink or calm myself down, or I'm exactly
steady the nerves.
Or no, you know what, man? I've had enough of this. Let's go down south, baby. I need to get away because everything's too much. So airplane companies. The purveyor of sins will always make money.
Oh yeah,
that's the truth of it.
So on that, guys, again, I didn't mean to be depressing, but the trick is, don't be conscious of those signals out there that are letting you know that things don't make much sense, and find a way to invest to profit off that nonsense. Because there is a way. There's always a financial tool out there that'll help you profit from it. And like I said, this is the reason why we built Invercio, because people, they think investing is hard. It's not hard. It's that mental step that's hard. Once you cross that mental step and you say, listen, I want to learn about investing, I want to open a trading account, and I just want to find opportunities, that's the first step. So check out our website, visit our web app, look at the content, subscribe to whatever social network platform we're on, because we're on all of them. Watch our guy, our finance bro, that gives you news in digestible bites.
Parth, my man.
I mean, these are key factors that are going to help you make money, and that might just actually help you have the best recession you can. Does that make sense?
Yeah. And most importantly, I want to say, if you're stuck in a bind and things are not going your way, cut your losses.
Oh yeah.
Think, a house is just a house. A car is just a car. It is not worth your mental health. So by all means, if you feel trapped and hey, there's tons of good lines out there. You feel like talking to somebody, do it, but don't sacrifice your future on hopes and dreams. Secure your present. That's the most important thing. And if that means cutting your losses, it's just stuff.
That's it. But on that, guys, be careful. Make money. Make money, money, money. Oh,
And
Donald Trump song. Money, 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 money.
money. Peace out.